The Office of Superintendent of Financial Institutions created the stress test in 2018, so buyers had to prove that they could manage rates well above what lenders are offering. The whole goal of this was that it would help reduce delinquencies.
Then the reality hit in 2018 when it was actually put in force, and it limited how much people could actually qualify for.
So here's a quote from Peter Rutledge, the financial superintendent. Essentially, the minimum qualifying rate has produced a more resilient residential mortgage financing system characterized by low default and delinquency rates. Would you agree with what he's saying?
I don't think so. Not a lot of mortgages have come up for renewal at this point in time. So any delinquency happening at this point in time, it's due to other outside influences.
Can you name a few?
Yeah.
So as you could see from this graph here, the debt servicing ratio for households in Canada has been kind of steadily increasing. And in addition to that, for every dollar of discretionary income, Canadians now owe $1.85. How did we get to this point?
Well, we live in a society where we want. So the loan-to-income rule that's now being suggested by the federal government is really going to regulate the lenders.
These guys essentially have to have their portfolio average out such that the mortgages that they're giving out to be 4.5x what their current income is. Welcome back to Season 4 Success, a show about finance, real estate, and food. My name is Callum Macpherson. Today I'm with Nick Da Silva, the president of Northwood Mortgage, and we're essentially going to be discussing the mortgage regulatory environment in Canada, as well as its impacts that it will have on mortgage consumers. Simultaneously, we're going to be cooking a rack of lamb, as well as some cauliflower steak. So before we get too into it, Nick, could you possibly reintroduce who you are and why this is perhaps such a prominent thing for people to learn about?
Thanks, Callum. My name is Nick Da Silva. I am the president and principal broker of Northwood Mortgage Limited. Been there almost 19 years, right? And we're in the mortgage brokerage industry. And as you said, we're here to talk about the regulatory environment that we're finding ourselves in right now. And let's hope we can educate some of your loyal followers.
Fantastic. So essentially, at the first, what I want to talk about is something called the stress test, which is essentially something whereby consumers have to qualify 2% above what their typical mortgage rate is. And so kind of since I think it was 2018, people have had to qualify not only for their rate, but typically 2% above. And so there are two regulatory bodies provincially between Ontario and federally, Canada. So OSFI, the Office of Superintendents for Financial Institutions of Canada, is essentially a national organization that essentially governs financial institutions in Canada, those under the National Housing Act. Simultaneously, there is FSRA, the Financial Services Regulating Authority of Ontario, and they kind of make sure that the mortgage brokerage industry is also quite, in a sense, ethical. And so what has happened was, and I'll quote the Globe and Mail here, the Office of Superintendent of Financial Institutions, the government agency that regulates federally incorporated lenders, created the stress test in 2018, so buyers had to prove that they could manage rates well above what lenders are offering. The whole goal of this was that it would help reduce delinquencies. And so if rates were at 2 or 3%, as we've been kind of historically saw after 2010, if rates rose, that people then have a buffer that they would qualify for. So knowing this, in a sense, whenever this was coming out, what were your initial reactions?
So you got to remember when this was first communicated to come out. It was in 2017, where we were in a very low interest rate environment. And so what we're seeing back then was people qualifying for a fairly sizable mortgage, where the reality didn't really make sense with what they were earning. And it was causing bidding wars as well, because people qualified for more. Then the reality hit in 2018 when it was actually put in force, and it limited how much people could actually qualify for. So it curtailed their ability to go crazy in these bidding wars to drive up the price of homes. And so the consumer had to limit their expectation. You know, that big starter home, which was in a brand new subdivision, a big house, might have to be called back to maybe a townhouse or something a little bit more reasonable. The starter homes came down in value, and basically what it did, it reduced their ability to borrow by about almost 18%. Right, so when you think about it, if they were previously qualifying for 5, now they might be qualifying closer to $400,000. So that limited, again, their ability to buy the very expensive homes. And unfortunately, again, it was put in place to sort of curtail or to protect the consumers from themselves, so that if and when the mortgage came up for maturity and rates had gone up, that they would be able to manage those kind of payments.
Awesome. And so as you can see from this Globe and Mail article here, throughout the real estate industry, there's been a lot of people that are now, in a sense, calling for it to kind of come off. Quote, mortgage brokers in the real estate industry have been calling on OSFI to relax the standards. In a sense, what are the effects of people not necessarily qualifying or having more difficulties qualifying and having to qualify for that additional 2%?
Well, again, we talked about the limitations on how much they could buy, right? But again, that was done in an environment when rates were nice and low at 2%. We saw some of the benefits back in 2020, 21, and early into 22 when rates were really, really low, right? But now we're in an environment where, you know, rates are in the 5+ range. I don't know that the stress test is required at this point in time. Keep in mind too, at a 2% over their contract rate, they have to qualify at a 7% interest rate. Not a lot of people are qualifying for that big of a mortgage. So now that forces, you know, a lot of people who are consumers who are looking to buy, they're forcing them to the sidelines in hope that rates will come back down and then they can get back into the market. So it's delaying their entry into the market. It is slowing down the real estate market, and I think it's hurting the economy in general.
Perhaps is it making it such that, or rather so that individuals were going more to alternative lending institutions rather than what we call A banks, including TD, Scotia, RBC type thing?
Well, that's another angle to it, right? If they were desperate enough or needed enough of a mortgage and couldn't qualify through an institutional lender, yes, that is pushing a lot more of the consumers to the private lending side, right? And I mean, the rates are higher, but they get what they're looking for. And unfortunately, it's going to, again, hurt the economy because then they have less spending money, right? And if they're not spending, then we might see a slowdown in our economy.
Okay. Now, there are tons of regulations in the mortgage industry, but are there any stories that you could tell of how this has affected clients without using names or exact figures?
Well, I mean, the same thing we were just talking about, right? Where clients are looking to consolidate, they have a need for cash. For whatever the reason might be, whether they're looking to invest or looking to consolidate, pay for the kids' education. And normally they would have gone to their bank or credit union to, you know, obtain the financing. They're not able to do it at this point in time, and so they're having to make a very tough decision. Do I go borrow from private lenders at an elevated rate, or do I stick with what I have right now and maybe not pay for my kids' education, or continue to pay those credit card debts, or not expand my business? A lot of decisions, hard decisions have to be made at this point in time, and again, a fair bit of it can be chalked up to this stress test.
Yeah. So here's a quote from Peter Rutledge, the financial superintendent. Essentially, the minimum qualifying rate for uninsured mortgages has produced a more resilient residential mortgage financing system characterized by low default and delinquency rates. Would you agree with what he's saying about it reducing delinquency rates?
I don't think so. I think what it has done is that it's prevented people from probably extending themselves a little too far when they're buying a house. But delinquency rates, I don't like. It's only been the last 5 years that we've had this stress test, and so therefore, not a lot of mortgages have come up for renewal at this point in time. So any delinquency happening at this point in time, it's due to other outside influences.
Can you name a few?
Yeah, people, when they buy a new house, they need to renovate, so they go borrow money. They have to get a second car, so they go borrow money. They want to put their kids in after school activities, so they borrow money. It's once you own a home, it's life happens, right? And people want to pay for everything, and they want it now. They want to renovate the house immediately. They don't want to wait 10 years. They want to have a new car versus a used car, right? The kids all have to be in activities which cost money. That money's got to come from someplace, right? And it's coming from their credit facilities, and it is a snowball effect, because as you keep borrowing, you got to keep making payments, and at some point in time, you only make so much money, and then when you can't start making those payments, something's going to give. And I think you're seeing it in the delinquency that we're seeing right now.
Big time. Okay, so now talking about the future of the stress test, a few quotes here. So this is from Phil Soper, the chief executive of Royal LePage. And so he said, when implemented in 2018, the regulator stated that this risk management tool was flexible and could be adjusted up or down with the needs of the economy. Now would be the appropriate time to lower this home ownership hurdle in order to allow more families to enter the market. In contrast, so Chrystia Freeland, the finance minister, has essentially said the minimum qualifying rate provides a buffer for home buyers and protects Canadians from changing economic circumstances, including increased interest rates and unforeseen personal circumstances. So with regard to the future, where would you say the stress test should be going, and where do you think it will be going?
So, I mean, again, coming back to my previous conversation or comments, the stress test has done a good job in keeping housing prices under some kind of control. Again, when we went through the lower interest rates for 2021 and 22, we did see the bidding wars and they drove up the prices. But for the most part, it's kept it in check. But I think there's limitations on it, because a lot of Canadians, a lot of people new to the country, first-time home buyers, stuff like that, would like to get into the market. They would like to buy a home. And unfortunately, the stress test is a major barrier at this point in time. It was great when rates were extremely low, so that people, again, don't go and over-exceed what their capabilities are. Well, on the flip side, when rates are where they are right now, it probably should be culled back to allow the people to be able to afford properties.
Yeah, and I mean, just to kind of show, like, we've been talking a lot about the negatives. The one thing in a sense about a positive, like, can you imagine if your interest payment, or rather your mortgage payment was like $2,000, then all of a sudden it jumped 2x and now you're looking at $4,000. Would that be a reasonable, between 2 to 3% to like 6%?
Yeah, I mean, that's a reasonable comment to make. Keeping in mind too that the 1 and 2% mortgage rates that we saw back in, again, early 20s, 21, 22, is not the norm, right?
Yeah.
Over an extended period of time. But over the last 20 years, neither is about 6% or 7%, which is where the stress test is at this point in time. So it's gone from one extreme to the other. It needs to be called back. I mean, we have to look at what the norm of our society from a finance position is, and I think that's where the stress test should be. So again, we're not accustomed to seeing a 7% mortgage rates. We're not back in the early 90s. So let's be, realistic in where the average rate should be, and put the stress test to that level.
Yeah. So we talked a lot about, in a previous episode, episode 1, essentially about where interest rates are at, where they've been, why they've upped so much or increased so much. If you're interested in watching that, you can see it up on the screen here. That being said, there is good news about this in a sense of where the stress test is going, albeit slowly. And so according to Mortgage Professionals Canada, for insured mortgage holders, essentially those who bought a house with less than 20% down, it's recently been said that if people are switching mortgage lenders, so let's say going from Scotia to TD, et cetera, they're no longer going to have to requalify under the stress test and that minimum qualifying rate. So they'll just have to qualify with that rate that they've already qualified with. Anyway, so now we're going to talk a little bit about the food we've got, and then we're going to go outside. All right, so the first thing that we've got is this nice cauliflower steak, or cauliflower. So what we're gonna do is I've got this olive oil and garlic, which is nice and simple. We'll baste, or rather mix the cauliflower with some of the garlic and olive oil, and then we'll put it on the grill. So tons of garlic, there's no shortage here. So now we're going to talk about a new regulation called the debt to income ratio, which was recently introduced. Essentially what that is the OSFI has said, the Office of Superintendents of Financial Institutions, that is it all federally regulated National Housing Act institutions?
Yes. Yep.
Okay, so all these guys essentially have to have their portfolio average out such that the mortgages that they're giving out to be 4.5x what their current income is. So the primary reason why this has been introduced is because Canadians are more indebted. And so as you could see from this graph here, the debt servicing ratio for households in Canada has been kind of steadily increasing. And in addition to that, for every dollar of discretionary income, Canadians now owe $1.85. And so, as OSFI said, the primary reason for this to be introduced is because of indebted Canadians. And so in a sense, how did we get to this point?
Well, we live in a society where we want something, we want it now, right? We don't want to be able to save for it, so we start borrowing on credit. And so, again, coming back to what we're talking about, we want a bigger house. We want a second car. We want a renovated house and the fancy clothes and our kids in all the after-school activities, and this costs money. And if we're not earning it, we're going to be borrowing it, right? So I don't think we're different from a lot of other societies and other countries, but we are borrowing to finance our lifestyles, and that's how we've got here.
Okay, so just circling back here, can you possibly describe the difference between the new loan-to-income rules and the difference between that and debt servicing ratios?
So the loan-to-income rule that's now being suggested by the federal government is really going to regulate the lenders. What it takes into consideration is the size of the mortgage compared to the income that's being disclosed. It's going to, number one, keep housing prices from skyrocketing, and number two, it's going to protect the consumer from overextending themselves when rates are low, and then if rates ever go back up, getting themselves into trouble. So it's a protection mechanism that the government's trying to use right now. There is the debt service calculation, which differs because that takes a look at your monthly obligations that you have to pay as a percentage of your annual income. And again, the financial institutions have a limitation on what that could be, right? And that's where they keep things in check. And there is a limitation. Some of them will go past a little bit if it makes business sense, but for the most part, they keep it at a certain level.
Okay, so one of the biggest concerns I think that people in the industry have raised has been whether it has, or rather this is going to apply to an individual or portfolio. So for instance, if I go to get a mortgage, is it going to be applied to that individual mortgage, or is it going to be applied to the portfolio of mortgages?
It's going to be applied to the institutions and their portfolios. As an individual, in the industry, there's a certain standard of maximum limitations on total debt servicing, which is the income qualification. And when it makes sense, some of the banks will go past that debt servicing requirement. It also comes back to a check when rates go back down, if they ever go back down to 2%, that people aren't borrowing 5 and 6 times their income, which is technically what they were qualified for back in the early 2020s when rates were extremely low. So
right.
It's a check on the kind of mortgage debt that they'll be able to handle going forward in the future.
Right. Okay. So then, in that regard, let's say that if I'm qualifying at 4x and then someone else is qualifying at 5x, do you think it'll be more like an average such that would equate to 4.5x?
Well,
is that how it work?
I think it's to be seen how OSFI sort of regulates this. I think lenders are smart enough and capable enough to make common sense decisions with respect to how much someone can qualify for. I think their measures will be, there'll certainly be checks within that industry to keep, the number of clients who are exceeding the normal debt service maximum to a certain level.
Okay. Do you reckon that, like, so right now, as rates are a little bit higher, it's going to be less of a problem because people are going to qualify for less, which means that this ratio is going to be lower. But as rates reduce, the ratio is going to get higher because then people qualify for more.
Correct.
So, in a sense, how prominent do you think it's going to be in the future moving forward?
Well, you know, the pandemic and the financial crisis from back in around 2007 were unique situations which caused interest rates to drop to the levels that they were at. I really don't see this happening again in the near future, so I don't expect that rates will go back down to that level. That would cause this calculation to be distorted. So I don't think it's going to be a big deal going forward.
Okay, so here's what we're going to do. I've got these ceramic blockers, and so what we'll do is we'll essentially put those underneath the cauliflower such that the cauliflower isn't exposed to direct flame. So essentially, we'll roast the cauliflower for about 10-15 minutes aside, checking up on it, and then after that, we'll put the lamb on. Okay, so the next thing we're going to talk about is amortization periods. And so that's essentially the length of time it takes, or rather the expected length of time it takes to pay off a mortgage in full. And so typically in Canada, we've seen, is it 25-year amortizations regularly?
Well, it started off at 25 years, and then back in the mid-90s, with the introduction of a lot of lenders coming up from the US, the amortization started to expand out. So it went to 30, 35, and as much as 40 years. In recent times, they've been called back by OSFI, so most lenders can't go past 35 years at this point in time. For an insured mortgage, right now it's at 25 years.
Right. So essentially with insured mortgages, those are mortgages that are insured by an insurance company, typically the Canadian Mortgage Housing Corporation. And so essentially what happens here is that they'll typically with insured mortgages, the down payment amount for borrowers will be less than 20%. And so what's happened recently for insured mortgages and for brand new constructed homes, the amortization period for a house has now gone up to 30 years. And so in a sense, the positive of that is such that they'll then have a lower monthly payment because the payment for that mortgage is now going to be spread across 30 years. The downside to that is because there's 5 more years, interest rates are going to be, they're going to pay more interest over time. So what are your thoughts about the 30-year AMs?
Well, this offer is right now only for first-time home buyers who are buying brand new homes from builders. So it really does limit that level in the market that is going to qualify for something along those lines. But again, it allows first-time home buyers, gives them a bit of an advantage over people who already bought homes to be able to purchase these homes. It helps the builders get their property sold, and even though they'll pay a little bit more over a longer period of time, it allows them to qualify for a bigger mortgage, which allows them to buy, more likely the house that they're looking for.
Do you reckon we'll see kind of amortizations extend beyond that 30-year mark?
If rates stay high, I can see that happening. However, the prediction, in the economic world right now is that they're not going to stay that high. So I really don't see it really going past the 30-year. What I probably do see is, second-time buyers or someone who's owned a home in the past looking to buy a new home is going to start asking questions, why don't they qualify for a 30-year amortization? People reselling a resale home are going to ask the questions, why is my house not qualified for a 30-year amortization? So I think what you see is the federal government opening the door to probably having 30-year amortizations again.
Right.
Callum looks perfectly done, medium rare. Let's try some of the cauliflower. We've been munching on the cauliflower. This is really good stuff. That marinade is really good, nice.
Fantastic.
Nicely done.
Thank you. Do you have any other, as we're kind of landing the plane here, are there any other closing remarks?
This budget has been quite eye-opening with respect to the mortgage industry. And we expect to see more changes as time goes along. Hopefully, the government's listening. Consumers are trying to afford homes to be, to purchase, to live in, and the government's got to do their share to help them get in there, or else we're going to continue to have this housing issue going forward.
Thanks very much, Nick, for coming on today and for watching the show. Have a great day.
Thanks, Callum. Thanks for having me.
Thank you.